The first step in learning how to invest is to learn how to buy and sell stocks. Equity investments have historically outperformed many other assets, making them a valuable tool for anyone trying to enhance their wealth. This video will show you how to get started with stock investing by learning how to buy stocks. With this foundation under your belt, you can move forward to advanced forms of investing. So what do you have to lose? Keep watching to learn more. Hello, my name is Financial and Investment Wisdom, and I'm here to help you achieve financial independence. Please subscribe to the channel and switch on alerts to receive updates of new uploads. Buying modest shares of ownerships in public corporations is all it takes to invest in stocks. The company's stocks is made up of small shares, and by investing in it, you're betting that the company will develop and perform well over the time. Your shares may become more valuable as a result of this, and other investors may be ready to buy them from you at a higher price than you paid for them. That means if you choose to sell them, you make a profit. Putting money into an online investment account, which can then be used to invest in shares of stock or stock mutual funds, is one of the greatest ways for beginners to start investing in the stock market. You can start investing for the cost of a single share with several brokerage accounts. The first step is to determine how you want to invest in the stock market. Stock investing can be approached in a variety of ways. The first step is to determine how you want to invest in the stock market. Stock investing can be approached in a variety of ways. Choose the option below that best describes how you want to invest and how involved you want to be in picking and choosing stocks. You can choose stocks or stock funds on your own, or you can hire a professional to assist you. You might be an excellent candidate for Robo-advisor. It is a low-cost management service. These services, which invest your money for you based on your individual goals, are available from virtually all major brokerage firms and independent advisors. You could also be the sort who says, I would like to start investing in my employer's 401k. This is one of the most popular ways for new investors to get started. It teaches new investors some of the most tried and true investing approaches, such as making small regular contributions, focusing on the long term, and maintaining a hands-off approach. Most 401k plans provide access to a restricted number of stock mutual funds, but not to individual equities. You are ready to look for an account once you've decided on a preference. You are now ready to select an investment account. In general, an investing account is required to invest in equities. This normally entails a brokerage account for the hands-on kind. Opening an account with Robo-advisor is a good alternative for people who need little guidance. Both techniques are described in detail below. A key aspect to remember is that both brokers and robo-advisors allow you to start a new account with very little capital. The do-it-yourself option to opening a brokerage account. Buying stocks, ETFs, and a range of other investments is likely to be easier and less expensive with an online brokerage account. You can open up an individual retirement account, commonly known as an IRA, or a taxable brokerage account, with a broker if you've already been saving enough for retirement in a 401k or in another plan at work. Opening a Robo-advisor account is a passive alternative. A Robo-advisor provides the advantages of stock investing without requiring the owner to undertake the labor involved in selecting individual investments. Robo-advisor services offer full investment management. During the onboarding process, these companies will question you about your financial goals and then create a portfolio to help you reach them. Although the management costs may appear to be high, they are often a fraction of what a human investment manager would charge. Most robo-advisors charge roughly 0.25% of your account balance. Yes, you can get an IRA with a robo-advisor if you want to. Now it's time to learn the difference between stock and mutual fund investing. Going to do-it-yourself route? Don't be concerned. Investing in stocks doesn't have to be difficult. For the most part, stock market investing entails choosing between two sorts of investments: ETFs, or exchange-traded funds, or mutual funds that invest in stocks. In a single transaction, mutual funds allow you to buy little amounts for different equities. Index funds and EFTs are mutual funds that track an index. For example, a Standard & Poor's 500 fund buys the stock for the companies that make up the index. You own small portions of each of those companies when you invest in the fund. To create a diverse portfolio, you might want to combine different funds. It's worth noting that stock mutual funds are known as equity mutual funds, stocks that are held individually. If you're interested in a certain firm, you can buy a single share or a few shares to get your feet wet in the stock market. It is feasible to diversify a portfolio out of numerous individual equities, but it requires a large investment. Stock market funds have the advantage of being inherently diversified, which reduces your risk. A portfolio consisting primarily of mutual funds is the clear choice for the great majority of investors, particularly those investing their retirement resources. Mutual funds, on the other hand, are unlikely to climb as quickly as individual equities. Specific stocks have the advantage of a great decision paying off handsomely, but the chances of any individual stock making you wealthy are quite tiny. Setting a budget for your stock market investment is the next step. In this stage of the process, new investors frequently have two questions. How much money do I need to begin stock investing? The amount of money required to purchase a single stock is determined by the price of the shares. Share prices can range from a few dollars to several $1,000s. If you desire mutual funds but don't have a lot of money, an exchange-traded fund, an ETF, might be the best option. Mutual funds have $1,000 or more minimum, but ETFs trade like stocks, so you can buy them for a share price, in some cases less than $100. How much money should I put into stocks? Well, if you're investing through funds, we have mentioned that most financial counselors recommended this method. If you have a lengthy time horizon, you can commit a significant amount of your portfolio to stock funds. A 30-year-old planning for retirement might invest in stock funds for 80% of his or her portfolio and bond funds for the other 20%. Individual stocks, on the other hand, are a different story. Limit those to a modest fraction of your overall investment portfolio. Now it's time to concentrate on long-term investing. Investments in the stock market have shown to be one of the most effective strategies to build long-term wealth. The average stock market return over multiple decades is around 10% each year. However, keep in mind that this is only on average for the entire market. Some years may be better than others, and individual stocks will have different returns. The stock market, on the other hand, is a smart investment for long-term investors regardless of what happens day to day or year to year. It's the long-term average that they're looking for. Stock investing is filled with complex tactics and approaches, yet some of these most successful investors have stuck to stock market fundamentals. That usually means putting the majority of your money into mutual funds. Warren Buffett famously argued that low-cost index fund is the greatest investment most Americans can make, and picking individual stocks only if you believe in the company's long-term growth potential. The smartest thing you can do after investing in stocks or mutual funds is to ignore them. It's best to avoid the habit of checking on your stocks and how they're performing multiple times a day, every day, unless you are trying to beat the odds and win at a trading day. Finally, keep an eye on your stock holdings. While obsessing over daily swings isn't good for your portfolio or your health, you need to check in on your stocks or other investments from time to time. If you use the procedures above to acquire mutual funds and individual stocks over time, you should review your portfolio at least once a year to make sure it's still on track to meet your investment objectives. Some things to think about. If you're nearing retirement, you may want to shift some of your stock assets to a more conservative fixed income investments. Consider buying stocks or funds in a different sector to diversify your portfolio if it's too highly weighted in one area or business. Finally, geographic diversification should be considered. International stocks should account for up to 40% of your portfolio, according to Vanguard. To acquire this exposure, you can buy international stock mutual funds. Overall, there are various advantages to investing in the stock market, including the opportunity for dividends and a 10% average annualized return. Returns are never assured in the stock market because it is so volatile. Diversifying your portfolio based on your financial goals will help you lower your investment risk. And that is it for today's video. If you want more discussions like this, please make sure to subscribe to the channel and turn on the notifications to be notified on every upload. This is financial and investment wisdom, and we'll see you on our next video.